During your reading this week, you will be learning about the functions of the foreign exchange market. Why is this so important? Because not all the world uses one currency. In fact, there are many currencies with different values based upon many different factors. As a global finance leader or manager, it will be important to understand what is meant by a spot exchange rate. Recognize the role forward exchange rates play in insuring against foreign exchange risk, and to compare and contrast the differences among transaction, translation, and economic exposure, and explain the implications for management practice. Exchange rate is the rate at which one currency is converted into another currency, either in a spot market or a forward market. In general, within the borders of a particular country, one must use national currency. However, when conducting business outside of one's domestic border, businesses most likely will have to use the foreign exchange market in order to 1. To convert the payments received for its exports, 2. To convert the income received from foreign investments, 3. To convert the income received from a licensing agreement with a foreign firm, 4. To make payments in a foreign currency to a foreign company for its products or services in the country's currency, to name a few examples. So how does the foreign exchange market function? Let's discuss the two most common ways. When two parties agree to exchange currency and execute the deal immediately, the transaction is referred to a spot exchange. Spot rates change continuously, often on a second-by-second basis, and are a reflection of supply and demand for the two currencies. The foreign exchange market is not located in one place, as it is a global network of banks, brokers, and foreign exchange dealers connected by electronic communications. One thing to note is the foreign exchange market never sleeps. The primary markets of Tokyo, London, Hong Kong, New York are all shut down for 3 hours. However, secondary markets like San Francisco and Sydney, Australia are open during those 3 hours. Another key feature of the foreign exchange market is the role of the US dollar as the primary currency, followed by the euro, the Japanese yen, and the pound sterling. Although a foreign exchange transaction can involve any two currencies, most transactions involve dollars on one side. This is true even when there is a need to sell a non-dollar currency and buy another non-dollar currency. For example, a company wanting to sell Japanese yen for Brazilian reais may find it more cost advantageous to convert the Japanese yen to US dollars and then simultaneously sell US dollars for Brazilian reais. In converting a currency, there are two numbers: a bid or buy price and an ask or sell price. Let's look at that more closely. If I want to buy 1 million Japanese yen, it will cost me $8,333.33. Then I immediately decide I do not want the Japanese yen. I would sell the same amount and will receive $8,130.08. This results in a $202.53 loss. The difference is known as arbitrage, and this is how traders make their profit. But what about the need to purchase foreign currency for some date in the future? So what about the forward exchange rate market? Let's take a look at that example. Forward exchange occurs when two parties agree to exchange currency and execute the deal at some specified date in the future, up to 360 days. However, if the currency markets are mature with sufficient volume, the forward market could go out several years. The forward exchange rate is the rate governing a forward exchange transaction at a specified date into the future. What determines a forward rate? There are many factors, like purchasing power parity, a country's economic environment, rising or lowering inflation trends, interest rate differentials, and market psychology. Let's see how this works. As we saw in the previous slide, if I had Japanese yen, I could convert to US dollars using the spot rate, which would convert to $8,333 on a spot basis. But that is not an option. So the choice is to do nothing but wait and convert at the spot rate on the day I have the Japanese yen, or execute a forward exchange contract to sell Japanese yen for US dollars at a forward exchange rate. The decision is made to execute a forward foreign exchange contract by selling 1 million Japanese yen for $7,692, which will be received in 6 months. The forward exchange rate is primarily based on the expectation of where the spot rate will be in 6 months, based primarily on interest rate differentials. By executing the forward exchange rate contract, I am locking in the dollar value of the Japanese yen in 6 months. However, as a global finance leader or manager, I could decide not to execute a 6-month forward contract, and then the Japanese yen would be converted to US dollars at the spot rate on the date I receive the Japanese yen. Let's see what happens under that scenario. As we stated, there could have been a decision to execute a forward foreign exchange contract by selling 1 million Japanese yen for $7,692, which would have been received on a specified date 6 months into the future. However, a decision was made not to execute a 6-month forward exchange contract, and on that day, 6 months later, the Japanese yen of 1 million would be converted to US dollars at a spot rate of 137 Japanese yen to 1 US dollar. As a result, you would receive $7,299, or $393 less than the forward exchange rate contract. So view the forward exchange contract as an insurance contract or a hedging contract against the possibility that the transaction may result in loss of funds. Are there markets for every currency in the world? The short answer is yes. The real answer is no. A country's currency is freely convertible when the government of that country allows both residents and non-residents to purchase unlimited amounts of foreign currency with the domestic currency. Freely convertible currencies are like the US dollar, pound sterling, euro, and Japanese yen. Externally convertible currency places limitations on the ability of residents to convert domestic currency. However, non-residents can convert their holdings of domestic currency into foreign currency at any time. A good example of that would be the Indian rupee. A currency is not convertible when both residents and non-residents are prohibited from converting their holdings of that currency into another currency. Governments will do this when they are wanting to stop capital flight and the draining of the foreign exchange reserves that it holds. A currency like this would be the Venezuelan bolivar. So, as a global leader or manager, why is foreign exchange movement so important? You need to understand what is the transaction risk, translation risk, and the economic risk when conducting business outside of the United States. Each company desiring to enter into the global business arena, where foreign exchange rates play a significant role in business activity, should undertake the following steps. 1. Centrally control exposure is needed in order to protect resources efficiently and to ensure that each subunit adopts the correct mix of tactics and strategies. 2. Have the capability to distinguish between transaction and translation exposure, and on the other hand, economic exposure. 3. Have the ability to forecast future exchange rate movements. 4. Establish good reporting systems so that the central finance function or the in-house foreign exchange center can regularly monitor the firm's exposures positions. 5. Produce monthly foreign exchange exposure reports. 6. Distribute the firm's productive assets to various locations so the firm's long-term financial well-being is not severely affected by adverse changes in exchange rates. The lack of active foreign exchange rate management has financially damaged many companies, some to the point of bankruptcy. This is an important concept to learn for any global finance leader or manager. On a personal note, for 3 years, I was a foreign exchange manager for a Twin Cities-based manufacturing company. My responsibilities included the management of our foreign exchange exposure, which was in the tens of millions of dollars. Without going into too much detail, I extensively used the forward market to execute hedging actions to cover or uncover our foreign exchange exposures. It was almost a 24/7 responsibility, as I did answer calls from Hong Kong, London, depending on the market movement.